there is likely to be a deficiency in the quantity of gold. So the report that they've got, what, 8,130 tons, or whatever the current figure is, is likely to be incorrect. And it's not just because it hasn't been audited properly. Um, I mean, you have to bear in mind that really from the sort of early 80s, when the LBMA really started going, gold was the basis of the carry trade in order to buy US T-bills. And so, you would go and lease gold, say, from a central bank, sell it into the market, apply the proceeds to T-bills, and so your cost of funding was roughly 1%, and the return you were getting was up to 10%. You know, and you leverage it up if you can, absolutely. I mean, this is a brilliant trade. But what happens to the gold? It goes into the market. Does it ever come back? Well, not really. That's the trouble. There are two aspects. In that article, I showed how the gold price, if you like, moved very similarly to how it moved in Germany after the First World War. And as I'm sure most of your viewers know, that culminated in a collapse of the Reichsmark. And the collapse was absolutely total. So we should, if you like, worry about why it is that the gold price is rising on the same sort of curve, if you like, as it was in the later stages of that hyperinflation. I mean, by the later stages, I mean really from about late 1921 onwards. And I mean, the answer to this is quite simple, and that is that the dollar is, if you like, in the early stages of its final life as a fiat currency. Fiat currencies always come to an end. And the reason they come to an end is that governments, the issuers, if you like, of fiat currencies, use them to supplement their taxes. And it gets to the stage where the debt is built up to such an extent that the whole thing eventually falls over. And that's roughly what we face with the dollar. And of course, because we have a global fiat currency system based on the dollar, it affects all of us everywhere. Your reference to 1929-32, of course, it was the big Wall Street crash, the bear market after the roaring 40s, roaring 20s, sorry, when you had a similar credit bubble, but this one is far bigger. Also, you had the Smoot-Hawley Tariff Act, which imposed extra prices on imported goods. This time, we've got the uncertainty because a capricious president keeps on changing the numbers. But there is no doubt that the combination of a credit bubble and trade tariffs at the top of that bubble is a lethal combination. This credit bubble will pop. And the reason that we can see that the end of the fiat currency dollar is approaching is because we know what the response to the authorities will be when that bubble pops. Because a popping bubble basically means there's more risk in credit, which means that bond yields will rise, borrowing costs will rise for anyone borrowing overnight or whatever. It doesn't matter what the Fed says the funds rate is. I mean, that's completely immaterial. But, markets look at risk and they have to price that risk, and they will price that risk in the knowledge that the purchasing power of the dollar is falling because that debt is being monetized. It's actually already being monetized because the Treasury is relying increasingly on the issuance of T-bills to fund its deficit because the cost, if you like, of funding at the long end of the yield curve is just too great for it. And, it's also found that there isn't really the demand out there along the yield curve, if you like, to support the level of financing. I mean, you've got the deficit, and also you've got all the maturing debt, which has to be rolled over. So, there's substantial refinancing problems there. And it's being monetized is really what it boils down to. This is very, very bad news. Already being monetized. And then this week we had the Fed turning around and saying No more QT. Now it's going to be QE, and we're going to knock a quarter point off the Fed funds rate. So you can see that the Fed has switched from trying to manage the inflation problem to trying to stop the economy from sliding into recession. So put all that together, you can see how the ghosts, if you like, of the Reichsbank are on the stage now. They don't really have the knowledge. And if you don't have the knowledge, you can't put two and two together. So it's the combination of that. I mean, bear in mind that the current cohort of economists, bankers, investment managers, whatever, are all trained in macroeconomics, which basically is Keynesianism. And so they don't actually understand economics. I mean, the whole of the Keynesian thing is a myth. It really is. It cuts out human action. And the idea that you can calculate and project from statistics exactly what the outcome will be is arrant nonsense. I mean, it really is. But they all, they don't have any substitute for that. That's the problem. They don't actually understand the legal position of gold either, because gold has been denied as part of the fiat dollar-led system for 54 years. But the fact of the matter is that gold is everyone's money, if you like, without counterparty risk. And it's embodied in everybody's common law. So, this is the idea that gold is just a pet rock now, or, whatever they like to call it, is just pure propaganda. And of course, everybody's fallen for it. So there's a huge, great re-education, not just of politicians, but of their advisors, which is necessary before they can really tackle the current problem.
When debt multiplies faster than private savings, governments turn to their central banks to step in. This is what's meant by monetizing debt, converting liabilities into money in essence. As the Federal Reserve shifts gears from inflation fighting to recession avoiding, the classic dynamics of rising bond yields, shrinking real yields, and a weaker currency converge. Investors see these signals, and gold enters the frame as a hedge against the resulting loss of monetary confidence.
Nowadays we sort of look back on the events of 1933 when FDR decided to, if you like, ban the ownership of gold, putting it very, very bluntly, and forcing individuals who held gold to swap it for dollars at the current gold standard, which at that time was $20.67 to the ounce. I mean, the point about it is that what he did was actually a clever way around property rights. Property rights are sacrosanct in an economy like America's. But at that time, we had an absolutely solid gold standard, which was de facto from, I think, about 1856, and de jure from the Gold Act in 1900. So there's absolutely no question that the dollar, at $20.67 was the equivalent of an ounce of gold. I mean, it was just absolutely simple. So using that basis, he forced everybody to exchange their gold for dollars. There was no confiscation. It was just an enforced swap, if you like, of property. So, of course, I mean, the fact that he subsequently devalued the dollar by 40% in 34 was, is a separate issue. I mean, that undoubtedly is what he had in mind when he forced everybody to submit their gold. So you can see that, it's a sort of, if you like, it's a bit of legalese, really. I mean, the effect was the confiscation of gold, but in legal terms, it wasn't quite, if you see what I mean.
Gold is no longer just a commodity or a pet rock. Central banks are accumulating more bullion. Investment flows into gold-backed ETFs are breaking records. Many analysts are forecasting gold at US $5,000 or beyond by 2026. At the same time, many market professionals trained in Keynesian economics may lack deep context for what this means. for gold is functionally money without counterparty risk. The reawakening of this idea is quietly reshaping portfolios and policy.
Mhm.
Um, I think it does actually inform us today. Would America do that again to its own citizens? I think not. I mean, the problem is that the gold standard, believe it or not, is at $42.22 to the ounce. So quite obviously,